Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 11th of November. This is the Armistice Day, so obviously always something to recognize from the massive First World War. Armistice Day, 11th of November. We've got Brent crude oil trading. This is Monday morning Asian trade, basically unchanged at 1 cent. Brent at $73.88, WTI at $70. It seems to a certain extent that Brent or crude oil in general has been left out of the Trump party. Let's kick off with Omar Najia, Global Head of Derivatives at BB Energy. Omar, Monday morning, a week ago, there was the day before the big American election. A week later, nothing's changed. All the other markets seem to be having a big party with champagne, and us over here in the little oil corner are left in the doldrums of low 70s and no joy for us. What's going on? Why are we not at the
Well,
Trump party?
so basically, I think, like we were saying a couple of weeks ago, Trump is structurally bearish for oil. He's negative for oil. So oil goes down. Anything to do with green energy and saving the planet and all
And
that
why
kind of
is he
stuff, that
bearish?
goes
Just
down
to recap on that,
because he
both.
wants to make America number one in energy. So he wants to drill, he wants to export. He thinks that energy is a strategic asset that should be basically invested in, right? So he thinks that you need to have hydrocarbons, you need to have gas, you need to have oil. If you have like a nice little virgin patch in Alaska with little birds on it, you basically drill and get the oil out because it's more important than the birds and all this kind of stuff. So he is aggressively pro making America great again in terms of energy independence, energy exports. He wants to bring back to the US industrial production, which requires energy. He wants to make,
But
he
does
wants to
that
do
all
all this
not all
stuff.
lead? I mean, one and one is two in the sense that that's supposedly a successful economic growth policy, and so more economic growth means more energy consumption.
No, because you're forgetting the other side of the equation, which is supply. So he wants to increase supply. He also basically wants to stop stuff like, I mean, he understands much more than the Democrats that stuff to do with sanctions against Russia and price caps and all this kind of stuff is, America's past all this stuff. He recognizes that he wants to make America great again. So he at least recognizes that it's not great now. The other side was just behaving like, nothing's going to stop us and we just need strategic patience, 3 years, 5 years, eventually Russia will collapse and all this kind of stuff. And we're going to do price cap and we're going to sanction insurance and freight, and nothing works and nothing is going to work because, I mean, I saw a very interesting statistic. China exports $1.6 trillion to the global south, exports to the US, 400 billion. 400 billion. Exports to the US, EU, and Japan, 1.3 trillion. Exports global south, 1.6 trillion. So China, the rest of the world isn't waiting around for basically the West. The rest of the world is moving on. Everybody's moving on. So I think basically oil prices will tick lower. I think the fact that MBS of Saudi Arabia didn't go to BRICS is also sending a message. And I think that Trump is definitely negative for oil, and you can see it in not only in the trading, but in trading of on the S&P. Anything to do with environmental, alternative energy, blah 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 blah, ESG is going down the toilet. So I think that this WTI needs to at least, at the very minimum, take out 65 and probably trade somewhere with a 50 handle. If this market can take out $78, 78.50, then we can have upside. But again, we're talking about lag. So the rest of the markets will go up on Trump and inflation and spending and that kind of stuff. Oil will go down first. That will help give the rest to Philip, and then oil follows. So first direction for us is lower for oil.
Peter Maguire, CEO of XM Australia, jumping in at late notice this morning because Mehmet Aguchu, one of our also regular commentators, fell ill overnight. I was hospitalized. So we hope Mehmet is doing well, and we will have him soon again on the airwaves. But Peter, I wanted to get a good opportunity to get an update from China, Asia, Australia this Monday morning after the big US election, where the other thing that happened in the noise of last week that didn't get a lot of attention, China did another kind of stimuli
Yes.
that fell a little bit on deaf ears. Your thoughts on the outlook from Asia this Monday morning after the big election?
Well, Sean, I think when we look at China and we understand the predicament they're in, and lovely to join you all. And yes, we wish our dear colleague a quick, quick turnaround as far as health. For every 1 unit of GDP the Chinese economy produces, it's 3.66 units of debt. So this is the debt burden that they face. We're in a debt spiral. We understand China's GDP ratio hit a whopping 366% in the Q1 2024. It's double the as far as debt to GDP of 2008 GFC crisis. So that's the critical issue, Sean. How does it deal itself out? We understand the Chinese stock markets had a big rally at the end of September, early October, extremely hot, up 20% or more. Some are 25%. They've given up a bit of hot air, but it's still extremely big lift off. Where we are with President Trump, and we understand the conditions, and as Omar said, it does seem to be a little bit of a race to the bottom as far as energy prices at the moment. We'll just have to see where President Trump wants to take this, but we understand 22% of global production is coming from the States, 64% of that internalized in shale, and he wants to boost that shale output to 80% or more. That's the word on the street. So if that's the conditions, then he'll naturally lift production. Is he capable of doing 25, 27, 28 million barrels a day? Who knows? He's going to make LNG the #1 producer as far as states, so that's going to be hard on Australia and Qatar, I'd say. So price is going to be interesting, that dynamic. Bitcoin's up 81,000. That's his favorite toy at the moment. And of course, US dollar index cranking through 105, Sean. It's really got a lot of hot air behind it, hot energy. So we'll just see how it rolls. Asia's looking interesting. US equities at all-time highs. Russell 2000 up 8.5% last week, Sean. Massive move. And you've got the Nasdaq. Who could have imagined? Nearly 19.3. S&P just shy of 6,000, and Dow just shy of 44,000. So everything is on fire with US equities, and US dollar up. Everything else is being crushed. Gold's off. So, great week for trading if you look at last week, and I think this week's going to be a great one to trade as well.
Yasar Al-Maliki, Gulf analyst at the Middle East Economic Survey. Also last week, Yasar, in the noise of the big American election, we had OPEC Plus a week ago, Monday, make the decision to postpone its plans to start to raise oil output that was due, as we know, originally on October 1st. They pushed it to December 1st. Now they've pushed it to January 1st, 1 month further delay. Your thoughts on that decision? OPEC meeting, of course, now in a matter of weeks. What sort of dilemma are they in?
Thank you very much, Sean. And of course, our best wishes to Mehmet Bey, a very good friend. I've known him for years now. Yeah, well, I think the group wants to be prudent, when taking the decision to raise output, to avoid seeing the market balances tip prematurely into oversupply, especially that, the concerns remain that we could see lower demand growth and higher supply from outside the group. I think this approach, which they called it at that time in June, being precocious, proactive, and preemptive, was put on a show earlier this month with the decision to delay the unwinding, as you said. It came at very strategic time. You just had the October data coming in, you had higher Libyan output, the risk premium was eroding because tensions between Iran and Israel were relatively lower. You just came out of a heavy refining maintenance season, and if you started putting back those barrels, you would go into oversupply early, tipping prices, depressing them. So, meeting so the decision, and we spoke with some sources, it was quite a quick decision, very quick one. You know, one source said that it took less than 2 hours, you know, for everyone to meet consensus. And, you know, you would assume that there was some muted dissatisfaction, you know, with some members that they were not able to bring production or raise production back, so, you know, as planned. But overall, the group showed, you know, strong cohesion. And I think they were taking the cautious approach, assessing the full situation before acting. So what happens now it's a crunch time, you know, for that December meeting. And, you know, OPEC ministers are under pressure now to assess market trends, you know, into the first quarter of the year. So, you know, whether further trade tensions between the US and China would lead to undermining economic growth, you know, not favoring them returning back the barrels on time. You know, they would also look at how this soft demand situation would reflect on US producers. Will they get, you know, to raise output next year now that President-elect Trump, you know, is expected to ease regulations? Is it technically and economically feasible for them to do that? You know, or would they prepare to be conservative and restrain production, you know, prioritizing shareholder returns? I know, I think Umar and Peter were a bit bullish on, you know, Trump going for drill, baby, drill. But by the end of the day, you look at the shale patch, you know, there is a lot of competition there. And you know, companies want to be conservative given, you know, you have 4 to 6 million barrels per day of spare capacity out there from OPEC. And, you know, OPEC is very cautious about what it's going to do. They want to put back oil, you know, and they could do it by the end of the day, despite the environment, you know, not least to give a signal to US producers that, you know what, we could, you know, you should be more cautious as well, you know, not just us. But OPEC also has to look internally. You know, you have the quota breakers, countries that have been overproducing, you know, above their quota since the beginning of the year: Kazakhstan, Iraq, Russia. You know, will they be able to deliver their compensation plans on time? You know, they want them to compensate for everything since January by September 2025. You know, they have improved their compliance in recent months, and I think this has been taken quite positively inside OPEC itself.
But not necessarily had much impact on the price from the point of view of, you know, tightening up of supply. Omar, let's look a little bit at the sort of all of these events from the point of view of inflation. Last week, as mentioned, all of the financial markets, the equity markets most notably, hitting even more records. And this is not new. It was a bigger record last week, but it's been record for weeks and weeks, it seems. And now we have, and in the middle of last week, what also went unnoticed to a certain extent, given everything else, the Fed cut interest rates by 25 basis points. So you've got record equity markets, financial markets, the price of money cheapening. You've got Bitcoin going ahead towards 100,000 and beyond. All of this signals to me still massive direction towards inflation. And I'm wondering your thoughts on that and what that means for oil going into this sort of immediate sort of new year as such. Obviously, inflation has been with us for a few years. The Fed reacted to it. Now inflation is still with us. The Fed's going the other way and equities are going through the roof. What does inflation mean for the oil markets, do you think, going into the new year?
Okay, first of all, we've been saying inflation for a while. Inflation is going to rage. The only reason the Fed is cutting rates is not because they've anything to do with inflation, but because the cost of their borrowing, the cost of the Treasury borrowing, is massive. It's $1 trillion and rising. Plus, they need
that's
to
going to
issue
get bigger
new debt. Yes. So they need to cut. They will cut. Inflation goes up. They don't care. They will lie and say, no, not really, and all this kind of, but they will keep cutting. They will cut, I think, another 1%. I think they cut another 25 basis points before the end of the year, another 1% next year. So it's going to be raging everything like we've been saying. So S&P towards the end of the year, 6,500. Next year, 8,000. I think people are going to be extremely surprised because they keep expecting stuff to keep going like it always does, and it's not going to do it. The world has changed completely. On oil,
I mean, ultimately, equity markets is in some ways the most obvious representation of inflation, rather than whatever the Fed marks or watches.
So if you look at the S&P for the last at least 40, 50 years, it goes up by the amount that inflation goes up. So if you put a dollar 50 years ago in the S&P, plus or minus, it was adjusted for inflation and you get that dollar back. Adjusted for inflation, that dollar is now, let's say, $100. But the S&P, you track it against inflation. It's exactly the same thing. So, which makes me laugh when people say, but if you look at the earnings and you look at, blah, blah, and strategically they bought, it doesn't work. All it does is it tracks inflation. That's one. When you look at oil is the most politicized, biggest trading commodity on this earth. It does not trade. It is a financial beast. It does not trade on supply and demand. It trades on money flow and sentiment, because that bit of it trades like, 100 to 1,000 times more than physical oil. And the canary in the coal mine is Saudi. I think that Saudi have an agreement with the US to push the price of oil considerably lower. That is why we heard a couple of weeks ago when BRICS was going on, Russians saying that, Saudi has to be careful because we can produce oil at $9 a barrel. We're still profitable. But for them to balance their budget, they need $100 Brent. Okay. So oil prices don't move according to, where companies invest and all this kind of stuff. The big idea where basically people get fooled and lose a lot of money or make a lot of money is the geopolitical idea. Now, if you look at oil, it is the worst performing asset in 2024, bar nothing. If you bought a bar of soap, you probably would have made more money than buying a barrel of oil, right? If I said to you that we have geopolitical tensions over the roof, a possible war between Iran and Israel, the shutting of the Hormuz Strait, blah, 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 blah. And what's the price doing?
Nothing.
Down. It's going to go down. So, we try and fit that into supply, demand, and all that kind of
let's
stuff.
go to demand, Peter. I mean, we had a fairly flat extra stimulus from the Chinese last week. I had some reporting on our podcast over the weekend that signaled, well, maybe the Chinese were holding back some of the big guns because they're going to need it when Trump comes at them with big tariffs in the new year. Your thoughts of where China's at, willingness, ability to stimulate their economy, and how challenged are they going into the new year?
Well, Sean, you've got to think of, what this impact is as far as the traction that they are trying to achieve when you've got this debt spiral. And this is the issue. So how do they get themselves out? They've either got to be tax incentives, infrastructure spends. It's got to be, I think, probably the re-engagement of domestic demand, and really try and get consumption going across the fabric of China and really boost that. And then you're thinking about, well, where does President Trump play, and the reintroduction of large tariffs for selected items coming into his.
I don't think it's selected. I think it's going to be across the board.
Well, pretty much across the board, but some are going to be more so than others. They'll be in the sense of luxury items. I've seen that there's different ratios.
What's the China reaction to that? Do the Chinese have a card to play against that, or what?
I don't know whether they do have a card to play, because when you're looking at non-financial corporates, they have the highest ratio as far as debt, and they're running at around about 171%. The government sector's at about 86%, Sean. So you look at the numbers and you say, well, what happens as far as consumption, and what does the government need to do to get to where they have to go to? And as you know, in a deflationary time, it's very, very dire from an economic situation. So what stimulus, how will it happen? Households, and I've got some notes here, and financial entities, debt to GDP is 64 and 45% respectively. So it's going to be very hard for consumption internally. It's going to be hard to deal their way out. And I think it's just going to be a work through to see where President Trump changes the deal of the game. And if he's to do what he says, which is to bring manufacturing back home, this could really cripple China, I think, over the next matter of years. If he is so aggressive, that's his ultimate strategy, is to bring all that manufacturing from offshore back to onshore, being in the United States. And it'd be to the, everything that Kissinger did, he's going to reverse back to the United States. And he's also, with the likes of Musk, and you've got to look at it really in the big picture, they want to downsize government by 80%, if not 90%, I heard. So all of those workers are going to be looking at new enterprises to join, and that'll be private enterprise and the likes of manufacturing or whatever else across, corporate America.
So big, clear. So China's toolkit to challenge this Trumpian tariff universe is going to be limited, and it's coming at a time when obviously they are also struggling. But it's also inflationary on a big way for the US, because everything obviously becomes more expensive if you put tariffs on it. It's not like the guys who are making it.
Well, there's another side to that as well. And he's talking about less tax for the consumer, for the US resident. He's looking at no tax on overtime. And he's talking about doing whatever the deal is going to be with the Fed. So there's plenty of talk about...
The deal with the Fed is you're fired. Let's go to Yasar and say, why did OPEC, Yasar, only extend a month? They did 2 months when they moved from October 1st to December 1st, and they did 1 month this time. So it's now January 1st where these increases are due. Obviously, OPEC meets in December. But also on January 1st, we have there are a lot of things OPEC are currently juggling in terms of cuts and rollbacks and so forth. But one of the big ones is the UAE get to increase their quota from January 1st. Do you think that gets postponed as well? What do you think why 1 month?
I don't think the UAE quota is going to be postponed. I think the UAE has, in a way, has been trying to get this for quite some time and has been building a lot of spare capacity and adding capacity that has been verified by OPEC sources. And I think within OPEC, it's all about cohesion and about, striking the right balance between all members, wants in a way. So I don't think that's going out, but I believe the 1 month extension has largely to do with the meeting, because the meeting is coming in December. Also, more importantly, looking at devising the strategy for 2025 as a whole. That December meeting is going to be important, and there could be a surprise there where we get a new kind of an agreement between the members to extend the cuts, maybe, depending on what kind of data loops in by then. Or maybe to see another extension, for 2 to 3 months, rather than going for a longer extension. And also we could see some of the barrels come back again. OPEC has kept it quite open and they were quite clear about it. We could pause, we could put these back, we could take them back again, depending on market conditions.
Let's go to the survey question, which is looking at the sort of thesis of our discussion this morning. Oil has not enjoyed Trump bump like most financial markets because baby drill policies mean more supply than demand. Agree or disagree with that? The outlook is what it is. Omar, looking at the sort of other kind of consequence of recent times, we've talked about the inflation, but we were in a week. The dollar had sort of gone through its peak and it was weakening with the lower interest rates, but it's had a bit of a recovery in the last period. Dollar strength. Your thoughts, Omar, on dollar strength? Does it have a bearing to play for the energy markets going into the end of the year? Does it have a continuation? Your thoughts, dollar strength?
Well, short answer is no. So basically, I think that the dollar trades basically against two major currencies, the euro and the pound. The euro, first of all, is trading around 107. I think the euro will trade below 106 definitely, and towards 104, 102. Once it gets there, I think basically it turns around and starts to go considerably higher. So new highs for the euro. But it's trading 107. I would buy it somewhere between 104, 102. So I think basically dollar strength will disappear as ephemeral. The other thing is the pound. The pound, I think, is a lot stronger than the euro. So it's trading about 129.50 plus or minus. I think it gets to 128. Once it gets to 128, it's a buy against the dollar. We're going to take out 130, 140, and higher after that. So I think this is so the dollar basically was extremely strong when it set those highs against the euro and the GBP. Sometimes at the beginning of this year, end of last year, I think, and then we rallied a little bit. We rallied strongly, actually. We rallied from about 103, I think it was, on the GBP up to about 135, 137, something like that. And then this is a correction. So I think the US dollar, the strength of the US dollar that we're seeing is corrective in nature. The trend of the US dollar is lower against sterling and against euro. First, it'll move lower against sterling, and after that, lower against the euro. So I would look to buy euro between 104 and 102 against the dollar, and sterling at around 128 or just below that.
Peter, looking out to the sort of end of the year, China typically going into the winter, the Chinese New Year, it's usually a good buying period for oil into the Chinese inventories. Your thoughts on whether that still plays out going into this sort of typically higher demand season in China and Asia as a whole?
Well, you would think so, Sean, and that could support certainly from a demand side. Yes, I'm having a look also at copper down 2.3% on Friday, so maybe we're seeing a little bit of that downdraft across all of those hard metals and the energy sector. So there could be further downdraft to, see where crude trends over the next, if it builds on what Omar's thinking and what I think the general consensus is. Brent probably under 70, maybe even those high 60s, and we'll just have to see whether it's got the legs to go lower. Yeah, I'm waiting here to see how the rest of the year rolls, because there are so many components to this. You've got a fully priced US stock market. You've got Asia's stock markets at very, very lofty heights. China's well bid up over the last, as we mentioned, the last 6 weeks has been absolutely electric. I want to see if any wheels fall off, Sean, because it just seems to be there's so much good market sentiment at the moment, or frothiness. This could quickly get wiped out. Are we going to see that other rate cut in December for the Fed? You've got inflation ticking up. Core PCE also forecast to have ticked up in the States. That comes out this week. 3.3%, expecting 3.4% or higher for October. So the storyline, 25% basis point cut for the Fed. The 10-year yield.
Well, just in terms of the, something, it's too good to be true, kind of everything is frothy. We've had the great wise Warren Buffett be selling a lot into cash in the last few months.
Yep.
What do you think he sees that not everybody else is seeing?
Well, Jeff Bezos as well, all of them are. So I think it's the old story, Sean. They're seeing the numbers. You can't get around the non-farm payroll that we saw last Friday. It was dire. There was 12,000 jobs, 40,000 were government, and 28,000 jobs lost as far as private, factory and so on. That really is damning, and that's going to cause much concern for Fed Chair Powell. He realizes I think the fragility of the US, employment situation is very dire. Companies are downsizing, and all of that's got to be washed across. So if you see a wipeout I don't know if it'll happen before President Trump's inaugurated, but I wouldn't be surprised, the first quarter, it's going to be very tough on US equities to continue this uplift. And so that in turn would impact, I think, Asian equities as well.
Let's close out with Yasar on the survey result. The agree is 90%. I always think when I ask a question that gets 90%, it's a bad question. Yasar, the geopolitics, of course, as we started our conversation this morning, are still raging sadly across the region. Geopolitics as in war, Israeli bombs dropping on lots of Arab countries. The situation in Europe continues to rage. We even had Ukrainian drones into Moscow overnight. So these are very real, active, live conflict zones that obviously the commodity and energy markets are not feeling exposed or vulnerable to. Are we underestimating the geopolitical risk here, or does it seem aligned to you?
I think it's the latter, to be honest with you. Part of it is because we have quickly accustomed to all of it. Trade has rerouted through the Cape. We have spare capacity. We haven't really lost any kind of major oil infrastructure, not here in the Gulf, not in Europe. Yes, supplies are down for gas, but nothing really that would keep Europeans not warm this winter. And we have ample supplies everywhere, ample inventories. Something interesting to look at, this week as the reports come out from the IEA and OPEC is like, what is the movement in all of these inventories? Is it going to be higher up, and are we going to see more, build-ups? So, but everything is healthy in terms of these things. Even when you look at the geopolitical risk, short-lived. I mean, you look at the situation in the region where we are. Iran is attacking Israel. Israel is attacking Iran, and this is doomsday scenario. And the oil prices move to what, 75, 77 max, and then they come down, just a few days after. So I think the market is comfortable where it is and knows that it is quite a transient, the geopolitical risk as it stands. As for Trump's, impact, I think there is not really muted, very clear hope that, maybe Trump is going to end all of these conflicts. I think it's one of the reasons why, say, Arabs in Michigan and in the US voted for him. And if that happens, I think, there is a lot of bullishness about Trump and, inflation, actually bearishness, he's going to add to inflation and so on. But, he could also, if a deal is struck with Russia, say, for instance, on a ceasefire, maybe we could see eventually, not in the near term for sure, maybe some cheap Russian gas coming back to Europe, spurring some economic activity, especially in places like Germany. You never know. You have 2-3 years to see any impact.
Yes, we do. And we would now also have an election in Germany coming up, which could join this trend to the right that we've seen across European elections. We'll have to leave it there. Monday morning, Brent crude oil sitting at its very comfortable place, $74 Brent, which ultimately means we are on track more or less for an $80 average for the year as a whole. And one would have to think most oil producers, whether they be sovereigns or corporates, would be pretty happy with that. More of the same, really. If that's the worst of it, then I think from an oil producer side, probably not too disappointed. Thank you, as always. Great to have Omar Najia, Global Head of Derivatives at BB Energy, leading us off each week. No better man for that. Peter Maguire, the brain in Sydney, thank you so much. And Yasar Maliki from the one and only MEES, Middle East Economic Survey, 50-plus years bringing great wisdom to the energy markets. Thank you, Yasar. Have a great week, everyone. All the best.
Bye-bye.
Thank you, Sean.
Thank you.
Cheers.
Thank you,
Bye.
Sean.
Bye. Bye.